on behalf of Joshua Antis and Sandra Torres of CalCoast, thank you all for your time in joining us today. I'd like to take a minute and introduce our Chief Investment Officer, Herb Morgan. Herb is our Senior Managing Director, along with being our Chief Investment Officer, one of the financial industry's recognized experts in the area of exchange-traded funds. He is the creator of the Efficient Market Advisors Managed ETF account. Herb is a regular guest on CNBC's The Closing Bell and has been featured in many publications such as Forbes, Business Week, and the Wall Street Journal. With that, I'll turn it over to Herb.
Thank you, Jeff. Thank you to CalCoast, and thank you to all of you for being here today and giving me this opportunity to speak to you from my desk in San Diego. You can see here, I am in the office today. Financial services is one of those industries that was exempt from the stay-at-home order, but out of an abundance of caution, we told all of our employees, especially those with children at home, that the only logical thing for them to do would be to work from home. But because we have things like your money coming in and out of the doors here every day that needs to be processed, we do have a skeleton crew of 3 of us in the office. We certainly miss the daily interaction with our colleagues. And with that being said, let me go ahead and get started with today's presentation. I think what we're going to try to do today is just give you kind of an overview of what's happening in the economy, how bad we think the destruction of economic activity, productive power is, how long maybe it's going to last, and what you could probably expect from a portfolio, from an investment perspective. So let's go ahead and get right into that here. First and foremost, if you are a Twitter user, you can follow me and get daily updates on the Twitter. That's at ETF_strategist.com. As a quick reminder, the legal folks in the firm here would like me to remind you that no part of this presentation is meant to be individualized investment advice. We ask that you speak to your CalCoast financial representative for investment advice. Everything you are seeing and or hearing here is informational, and there are no recommendations at all being made for the purchase or sale of any securities. So let's go ahead and get right into it and what's going on here. This is data that you see through, wait a second here, you know what I think I have done? I apologize to all of you, but I have put up the wrong presentation. As soon as I saw the numbers, I realized that. I am going to discard this, bring in a new presentation that I made especially for all of you today, and I'm going to start it. So there you go. See, I added the date and your CalCoast logo. How's that for class? Okay, here's where we just were. Through the end of the day on Friday, the stock market, as measured in this instance by certain equity indices, was down about 12%, down about 12% in the S&P 500. That's a very significant recovery from the low that it reached on March 23rd. So we're just about a month away from the low. The further and further we get from that low, it's more suggestive that it was the low. We don't know for sure. We won't know for years to come whether or not we go back and retest that low or not. There are a number of good signs to suggest that it was the low, but there are still some others to suggest maybe it wasn't. One of those negative signs is that we haven't seen as much recovery in mid-cap stocks or small-cap stocks. Small-cap stocks are still down 30% through Friday. International markets are also down, and down a little bit more than they are in the United States. Whenever you see a broad risk-off environment where stock market sells off considerably, as exactly what we've experienced so far this year, you tend to see a flight to safety. The only safe, truly safe and guaranteed instrument is a U.S. Treasury security. And the U.S. Treasury index of 20, with those with more than 20 years of maturity, is up about 25% year to date. In my view, that makes it incredibly overvalued, assuming that we get an economic recovery. If you get an economic recovery, and an economic recovery is in my view, highly likely in the second half of this year, it makes the equity markets rather inexpensive, i.e. buy low, and it makes the treasury market in particular very expensive. Some differentials though, if you look at high yield and other investment grade bonds, not just treasuries, but corporates, credit we call it, they're down, still down considerably, and they also represent some pretty decent value. But make no bones about it, this is not my first bear market. We had a couple of young 20-something employees here at Efficient Market Advisors, and this is their first bear market. I started in the business 33 years ago, right before the crash of '87. So I've been through quite a few bear markets, quite a few recessions. I didn't think we'd ever see one as significant as we had with the global financial crisis of 2008, 2009. But clearly this is pretty significant. I break bear markets up into one of three types. And one of the three types, the first one is what I call structural. That's where you have a long building, significant dislocation or bubble or imbalance built into an economy where a lot of economists are talking about it, they're pointing it out, but maybe the policymakers aren't doing anything about it, there's debate. A great example of that would be the bubble from the 1999 dot-com. Stocks were just extraordinarily overvalued. Then we had the big real estate bubble where we had over leverage of the financial system in 2008. Those were structural bear markets. Structural bear markets tend to have very long, drawn out declines. They average about 42 months from peak to trough. That is about 57% average decline. And the recovery period is nearly a decade. Those are the type of bear markets as a portfolio manager where if you see that on the horizon, you want to begin to take action and maybe reduce some of your risk exposure if you see it and agree with it. The second type is a cyclical bear market. And we've had a lot of these in my career, in my lifetime. If you remember back in the 1970s, we had excessive inflation in this country. So the Congress gave a new job to our central bank, the Federal Reserve. And the new job they gave was maintaining price stability, which interpreted was, don't let us have inflation ever again. So what the Fed has done since that time, since the 1970s, is that whenever inflation started to creep into our daily lives, the Fed would try to squash it by raising interest rates. That inflation was usually driven, at least since the 70s, was usually driven by energy prices, energy being controlled by an oligopoly or really a cartel outside of the United States in the form of OPEC. And the United States economy was very dependent upon the free flow of energy, oil, at market prices. When inflation came in, the Fed would take action, it would slow the economy. Sometimes it would slow it too much and cause a recession. Cyclical bear markets typically decline by about 30%. So about only half the decline of a big structural imbalance. They tend to manifest themselves over about a 2-year period, and then the recovery period is much quicker. A pandemic, a global pandemic, which necessitated or inspired a voluntary shutdown of economic activity, is neither of these. A pandemic is a shock to the system. It's a sucker punch to the economy, if you will. It could be driven by something we just didn't see coming or didn't predict. It could be a war, an oil price shock like we have gotten in the past, the emerging markets crisis of the 1990s. All of these things can cause this to happen. What we've seen here, though, is that the average declines tend to be less. The duration tends to be significantly shorter, and the recovery period tends to be significantly or substantially quicker. But just because the last 3 exogenous shock bear markets were like this doesn't mean the next one will be. In statistics, we say you need 100 examples of something to begin to draw any conclusions. That's why this whole coronavirus pandemic is so difficult on math people like me. You don't have data, reams and mounds of data to go by. You have to make presumptions and assumptions, some of which the experts are definitely going to get wrong. I think they would all readily admit that. So if all exogenous shock bear markets are unique, what are some of the defining characteristics of this one? First of all, we've never had one that was driven and triggered by the outbreak of a disease. We didn't have a big, this has never happened before. I walk, across the street here and there's no cars and there's no line for me to get my burrito for lunch. We've never also had a shock to the system where we had interest rates already nearly at zero. In other words, we've sort of lost some of the efficacy of what cutting interest rates would normally have done for an economy. Oh, we had this little shock. There was that happened globally. Cut interest rates for 6 months. That'll get the economy stimulated, and then we'll go back. Well, we don't have that this time. The closest thing we have to look at was the SARS viral outbreak, which occurred, and it did impact markets. Didn't turn into a big, bad, deep recession of this size, this shutdown of this size. But we do know that the stock market began to rally and bottom well before SARS was solved or became in the distant. Markets begin to rally when the infection curve decelerated, or we call it now colloquially flattening the curve. I'm going to bring a screen. I'm going to bring a little window into the screen here. I'm going to talk to you about the coronavirus confirmed cases in the U.S. The U.S. is probably one of the best because we've done more testing, according to our leaders. We've done more testing, and if you have more testing, that's more data. More data is always better than less data in an analysis situation. This is a graph of the curve. This is a graph of confirmed cases in the United States. But we can only really look meaningfully at a curve like this with a logarithmic chart rather than a linear chart. So if we graph this logarithmically, showing the daily percentage increase, you can see that the curve has, in fact, done what we wanted it to do, which was to flatten. If I put my little tracker on and I go to March 23rd, right there, March 23rd was the bottom for the stock market so far. And as you can see, since then, that is exactly when that curve began to flatten, which makes me believe on the margin that that's one sort of, if I'm weighing up or down for the market, I would say that March 23rd was probably closer to the bottom. The other good thing, if you can say there is a good thing about that what's happening right now, is that our economy, the American economy in general, was in really good shape. If you're going to get a sucker punch, which is what's happened to us, you'd want to do it from a position of strength. You'd rather get a sucker punch to Mike Tyson in his prime than to Pee Wee Herman. It would have been much worse if we were already in recession, or if unemployment was already high, or God forbid we were fighting inflation. Because we had none of those problems, it's allowing policymakers to bring large scale tools to the economic fight that lies in front of us or is with us currently. Think about this. In mid-February, late February, actually, let's go to the end of February, we had January and February back-to-back jobs growth of 273,000 a month. That is, by historical standards, just very significant. We had unemployment down to 3.4%, was the lowest level in over 50 years. More importantly, real wages were increasing. It's one thing to have nominal wages go up, but if the cost of living goes up more, then your real wages have declined. When you have real wage growth in an economy, you raise the purchasing power and the standard of living of the people in the economy, and that is a self-fulfilling positive feedback loop. So real wage growth is just desired. It's always desired in an economy. If you can deliver that, you're in pretty good shape, and we were as an economy. Now our economy, I break it down into services versus manufacturing. And the United States has migrated over the last several decades to become a primarily service-driven economy. About 86 or 87% of our economy is services. So each month there's a reading from the Institute for Supply Management. You can get on their distribution list or look it up online, ISM services reading. And if the number is above 50, your economy grew. If it's below 50, it shrunk, it contracted. The ISM services reading came in at 57.1 in February, which had been steadily accelerating through the end of 2019 and the beginning of 2020. The manufacturing was a drag on the economy, which is about 15 or 16%. It was a drag on our economy last year. It was a drag because the US decided to renegotiate a number of trade agreements. The United States decided to renegotiate with Mexico and Canada, its two biggest trading partners, Japan, Korea, and China. In doing so last year, it significantly negatively impacted growth. The service sector still grew and we had positive economic growth last year, but the supply chain disruption really held things back. And it was only in February that the ISM reading for manufacturing had gotten above 50. And because that had happened, estimates for GDP, which we all came out with our estimates back in December, those estimates were all being revised higher as recently as the end of February. In fact, the Atlanta Fed GDP Now tracker, it's an index that I see every day online. Every time an economic data point is released, the number goes into the calculation, and it's a real-time daily change indicator of where GDP might be headed. And it's widely followed, and it's pretty darn accurate. It was greater than 3.1%. In fact, it got to 3.25% before it started to roll the other way. So if there's good news, this bad situation couldn't have happened at a better time, if that makes any sense. We are just now beginning to get economic data that reflects the economic deceleration. So some of the economic data is delayed 2-3 months, so it's still coming in good, and it should be completely ignored, to be sure. Start first with payrolls. This is the jobs report for the month of for the month of March. You can see there that the March number shows that we lost 700,000 jobs. Well, the economic slowdown didn't even come to the latter half of March. So this number, even though it does show the extent of that massive drop, you can see that massive drop down here compared to a decade of monthly job gains. You can see here. We believe, obviously, that in March there was more losses than that, and in April there were more losses than that, significantly more losses than that in April. We can kind of tell from the weekly claims for unemployment, which have obviously skyrocketed, gone through the roof. In terms of that ISM services, ISM manufacturing reading, I had mentioned it earlier that it had been below 50 for a good chunk of 2019. You can see it here. And then we got some trade agreements in place, and we had just begun to get above 50. And unfortunately, we are now back below 50 on ISM manufacturing, meaning the manufacturing sector is contracting. Same can be said for the services sector. It hasn't gone below 50 yet, but I would bet anything that when the reading is out for the month of April, all you have to do is look around town. You can see everything is closed. That ISM non-manufacturing or services reading is going to be somewhere down in this level. It's going to be very, very, very bad. All of that is also therefore working its way into the GDP calculation. As I said, the GDP Now number was predicting 3.25% growth for the US as recently as March 20th. As of just last week, that is now down to a negative 0.3%. But remember, this calculation just is it's formulaic. It takes the data we're receiving, and if the data we're receiving is still very delayed, I can almost, again, guarantee or bet that this number for GDP in the coming days and weeks and months is also going to get significantly lower. All that being said, it's horrific news. Why is the stock market up over 25% since in a month? I mean, we are literally up 25% in a month. And the answer lies really in, number one, there is obviously an understanding by everybody. You don't have to be an economist or a portfolio manager to know that this is temporary. This is a transitory thing that's happening to us. But there's also a massive difference in the rapidity and the size of the policy response, the rapidity and the size of the policy response that we have today versus that of 2008 and 2009. In the 2008 and 2009 financial crisis, there was blame going around. There was a lot of blame. There was people that were angry with the banks. We allowed Bear Stearns to fail. We allowed Lehman Brothers to fail. We said, how did this happen? We let them lever their balance sheets 20, 25, 30 times leverage, and Fannie Mae and Freddie Mac, who both completely failed, went into receivership. The corporate side would blame the government side. Well, you encouraged us to make more loans. You wanted home ownership was a policy objective of every political party and every president going back as far as we can remember. And so you made us make loans that maybe weren't safe, but at the same time you gave us carte blanche or the banks went and got carte blanche to take on more risk themselves and lever it up. So they were kind of hand in glove, government and the private sector, hand in hand, walking together, doing something that they kind of both knew was not right, and it blew up. So there was not a lot of love going around, if that's a term, to provide taxpayer or central bank assistance at that time. In fact, it was a long, drawn out series of negative quarters of GDP growth. 4 out of 5 quarters were negative. It took a full year to pass fiscal stimulus in the form of the Troubled Asset Relief Program, or TARP. So that got passed in November of 2008. The crisis had already been raging for a year at that point. And all we had up until then was a $150 billion fiscal stimulus plan that took place in the spring of 2008, and it was just kind of gone. Remember cash for clunkers, they had little ideas. These were little ideas. It took 18 months to pass the PPIP, which is the Public-Private Investment Program. That was passed in March of 2009. The market bottomed, the equity markets bottomed from really November of 2008 to March of 2009. The ultimate one-day low was March of 2009, but it's about a 4 or 5 month bottoming process. And it was the policy response of the Federal Reserve, obviously, and the TARP and the PPIP, which ultimately had the effect of turning the markets and restoring confidence to the U.S. and therefore the global financial system. And during that, then from there, it took 5 years, a full 5 years, for the S&P 500 to get back to even. Now we have to compare that to this response today. I think scale matters, and I think as much as we're all disappointed being at home, we're missing our activities and all of those things. The size of this needs to be put in perspective. I'm going to call it the Corona crisis, for lack of a better term. First and foremost, right out of the gate, the Fed cut the Fed funds rate by 150 basis points. They announced 1.5 trillion in reverse repurchase commitments. This basically just provides liquidity and functioning to credit markets. Why do you want to do that? Well, if your credit markets cease to function, then your economy ceases to function. So the Federal Reserve is stepping up. They also are expanding the money supply by going out and purchasing bonds, treasuries, and agency securities. They announced $700 billion to do that. They immediately removed the $700 billion cap and said there is no cap. And by the way, we're not just going to purchase government securities anymore or agencies. We'll buy whatever the heck we darn well please. And they restored functioning to the high yield credit markets and some other credit markets at the same time. They established the primary corporate credit facility, a secondary, a term asset-backed securities facility, and there were 2 facilities that were created to prevent money markets from breaking the buck back in 2008. If you remember, the Reserve Money Market Fund did break that buck. Many people falsely believe that a money market is guaranteed. There is not like a money market fund. It's very low risk, but it's risk. They restarted these facilities in dealer credit and commercial paper in order to assure that we didn't get where we got in 08 and 09, and that has absolutely worked. They also, on the fiscal side, we got a quick $8.3 billion phase one stimulus plan on March 6th, $1.3 trillion plan on March 13th, and a $2 trillion plan on March 26th, recently about to be expanded probably today or tomorrow on as part of that phase three plan for the small business paycheck protection program. We also got 50 billion released from a pool that's reserved for state of the emergency, the president's discretion. 300 billion is left floating in the system because we didn't have to pay taxes on April 15th. We were allowed to keep the money until July 15th. Therefore, with that money circulating, that will add to economic activity. Not to be outdone, the International Monetary Fund has made $1 trillion of lending available, kicked out 50 billion in loans. The World Bank has made 12 billion in loans, and I can't even list all of the countries that have announced economic and fiscal stimulus. Obviously, our two biggest trading partners, Canada, among our two biggest, Canada and Mexico, both announced big fiscal stimulus programs yesterday. But that 2 trillion isn't done. It goes on. It's like the commercial. Wait, there's more. We've expanded unemployment insurance to cover gig workers, the Uber drivers. Additional benefits are available for healthcare providers who need relief under this situation. We've got big block grants to the states to fill their unemployment insurance funds, the coffers, if you will. Direct payments to anybody with an adjusted gross income of $150,000 for married couples, plus $500 per child. The purpose of that payment is for you to spend it if you got it. They want you to spend it because every time you spend money, you contribute to economic activity and to the GDP. They are assuming that you will spend it. If you are unemployed because you got laid off before the Paycheck Protection Program, your benefits go longer and they're larger. The idea is the more you have, of course, the more you'll spend. None of this, of course, comes without cost or risk. The risk, though, is being borne on the federal balance sheet in the form of debt. Interestingly, or luckily, cost of debt is at incredibly low levels right now. We had 350 billion. I mentioned that that was part of that plan, which is being expanded likely today. Another 500 billion to allow the Treasury to make emergency loans to large corporations to keep their employees on, particularly things like the hotel and airline industry. There's a lot of money for specific industries like air cargo and airlines. 100 billion in grants to healthcare providers, 16 billion for the government to rebuild its stockpile of medical equipment, matching Medicaid funds, and big payments for hospitals treating COVID-19 patients. And even bigger, $150 billion direct payments to local and state governments to deal with the crisis. That's a lot. It's massive, and it leads us to believe that at least what they're trying to do is make the recovery bigger than it would be normally, because shutting down an economy, the longer you shut down, there is a negative feedback loop and a compounding effect to the downside. It's kind of like the earthquake Richter scale, an 8.1 is 10 times higher than an 8.0. Well, each day or week that you prolong an economic shutdown, the damage actually becomes greater because it's harder and harder to restart and reboot. So let's move on from the economy and the stimulus, because I think I've probably got you all thoroughly depressed at this point. Now let's talk more about your portfolios and the stock market. The bottom line for me was that on March 23rd, the equity markets were just extremely oversold. They were more oversold than they needed to be. In other words, the price decline, in my view, overweighted the reality of the economic situation and underweighted the likely speed and rate of economic recovery. So I'm going to bring in my chart again because I love charts and graphs, and we're going to have a little fun. And we're going to take a look at the S&P 500 index, and I'm going to graph it out for you. And as you can see, this bottom, I can bring in my little track here, right there was March 23rd at 2237. That's about a 34% decline from there to there. from February 19th to March 23rd. That's less than a month to lose 35%. Well, now since then, right, it's gone back up. In addition, something called volatility, or VIX, we call it in the industry, peaked north of 80. So let's bring that up, and I'll show you that because I think it's really exciting stuff. This is a volatility index. I'm oversimplifying it for a moment, but when this goes up, it means that the price of options that professional traders use to maybe hedge portfolios or insure portfolios are going higher and higher and higher. Loosely interpreted, it means that the expected daily movement up or down in the stock market is going up, the percentage movement. So you can see down here when things are normal, the average daily move is, 1.5 to 2%, 1 to 2% on a daily move. Well, back here on March 16th, the average expected daily move of the stock market was about 8% each day, up or down. With that number coming down now, still very high at 4%, it tells me that the economy and the markets are beginning a recovery process well in advance. The markets are beginning it or discounting an economic recovery that'll certainly come down the road, a little bit lower. We saw back in 08 that the VIX here, also above 80, peaked prior to the stock market bottom by about a week. And that's exactly what happened in this situation as well. So the bottom line is they were pricing in about a 60% decline in profits, which really makes no sense. By comparison, in the global financial crisis of 07, 08, 09-ish, whatever you want to call it, profits declined about 45 or 46%. So why did it go down so much? Well, when I started in the industry over 30 years ago, we had some rules about short selling, and program trading was just barely a thing. People had to have an idea, write the idea on a ticket, walk it down to a wire room, and place the order. Today, we don't have that. We've gotten rid of the uptick rule, so there's really mostly unencumbered ability to short sell. It can be done via automated algorithmic-based computer programs by people that are using tremendous amounts of leverage, far more than, say, you would use in a margin account for a brokerage firm. So when these programs are selling, it begets more selling, and it then has a negative feedback loop. And I believe that's what happened in late March. I also believe, unfortunately, that may have impacted some long-term investors. It's very important that you always maintain your perspective as an investor. I'm 53 years old. I'm a long-term investor, and I want to retire at 65. But I shouldn't then change my investment strategy tomorrow because of what the market did tomorrow or today. It makes absolutely no sense. Yet many investors did just that. They get panicked by the activity. More importantly, they get destroyed by misleading financial headlines, which I'll show you in a moment, and they make mistakes that they will come to regret. I strongly believe they will come to regret. So as the COVID curve continues to flatten, that's the logarithmic curve, I expect things to continue to get better from a portfolio standpoint. Needless to say, I expect first quarter GDP and earnings to be negative, but only slightly, because we had a lot of orders, corporate orders placed in January and February that were filled in March and April, as an example. It's the shutdown of April that's going to be impacted in second quarter earnings and second quarter GDP that has yet to be fully realized, but I think is more than fully discounted in the market. Now, I want to have a little bit of fun, and I wish that this was a smaller group. I mean, I'm glad it's a massive group, but I can't get any talk back and forth. I love getting the audience to raise their hand. I can't do that in this situation. But headlines are incredibly misleading. There's so much argument in our country today about the press, and is it being honest or dishonest? Is it biased for the right? Is it biased for the left? All of those things. I don't know that I want to get into that discussion, but I will tell you, as having someone who's been interviewed in the financial press many, many times, when I go back and read what they say that I said, I don't think it's intentional, but they don't ever get it right. It's, oh, no, they didn't understand. I wasn't clear enough. The writer was a writer, not an economist, and it's just wrong. And I think also too that there's a rule: the more clicks you have, the more money you make as a journalist, and therefore you need to make the headline as titillating as you possibly can. I want to show you a couple of headlines. This is Fortune magazine about a week ago. It says 30% GDP drop. Morgan Stanley, big name, joins Goldman Sachs, big name, in upping estimates of coronavirus economic pain. That is followed by our good friends at CNBC, where I appear regularly. They're quoting a former chair of the Federal Reserve as saying second quarter GDP could decline by 30%. They were a little bit honest in there, a little bit less dishonest than the Fortune headline. Forbes says that JP Morgan forecasts a 20% unemployment and a 40% hit to second quarter GDP. That gets followed up by Bloomberg saying that Morgan Stanley says the US GDP could drop by 50% in Q2. Now I have an advantage. I have my terminal here, and I have the consensus estimates of all the economists that contribute, and I pay a lot of money for this service. And I can tell you that first and foremost, they absolutely cherry-picked the analysts or the economists they will quote. In the service that I have, I can see all the estimates from all the economists, not just the investment banks, but the academics, the think tanks, the nonprofits, the government, the central banks, the Federal Reserves, the international nonprofits. Those are all in there. And there is a consensus that we're in a recession, don't get me wrong, but let's talk about it. First of all, if we're going to talk about GDP contracting, we need to know what GDP is. GDP is consumption, that's what we all do every day, plus government spending, plus investment, that's capital investment, building, plant, and equipment, plus the balance of trade, exports minus imports. That's the formula. The current consensus of 98 sets of economists that report in, probably a better place to go than a headline, is the following. For all of 2020, consumption is going to decline by 3.6%. It may be a little more, it may be a little less. Government spending is expected to be up by 2.6%. In fact, I think we could all agree, based on what we're seeing every day in terms of fiscal passage, that government spending will actually go up. The biggest hit is going to come from capital investment. That is delayed building and expansion, delayed building out of a new wing or a new facility or a new factory floor. Expecting that to decline by 7.5%. Exports down by 4%, and imports down by 5%. But that's in black because imports subtract from GDP. So if we have less imports, that adds to GDP. Therefore, the actual expected hit to GDP for all of 2020 is a substantial, not insignificant, 3.4%. But how do you compare that to a headline that says 40 or 50% that might cause you as an investor to panic unnecessarily? Call your CalCoast financial advisor, they try to calm you down, you can't, and you sell your investments right at the bottom of the market. March 23rd would be the worst possible situation. So what is it that these headlines are doing? They're taking a quarterly change and they're annualizing it. There's nobody, not one economist, not even the ones they talked about in those press releases, in those stories rather, that is predicting what they said. What they're saying is if the economy shrinks in the second quarter at 6.7% and then does it for another 3 quarters, it's a compounded negative impact, then we'll have a total of 24% decline in GDP. Take that number to 16%. If second quarter is down 16, and then you get another 16, another 16, and another 16, then you'd have your 50% or your 40% or whatever. But again, it's that manipulation of that headline, and if it causes you angst, then they're not really doing any kind of service to the public, in my view. So let's talk about what are those estimates. Let's break them down. This is year over year quarterly growth rates for the 4 quarters of 2020 as they stand today, consensus of economists. First quarter is still estimated to be positive by 1%. Second quarter is estimated to have a big hit. And the third quarter is expected to have a big hit. But remember, that's not -4 off of -6.7. That's -4 off of the prior year's third quarter. In other words, the damage is getting less and less. So your total for 2020 is expected to be -3.4. That's why the headlines and the articles are not the place to go for this kind of information. 2021, we're expecting 3.8% growth. All these numbers can change. Economists, we can all go in and change our estimates and everything in the system. But this gives you an idea. It makes you, when you look back now at these headlines, they seem pretty darn silly. And they are silly. And I just want to really encourage you as an investor. I know it's a hard time, especially if you're out of work, if somebody in your family's out of work, worse if you are ill, if you are impacted medically from this disease. It's a very difficult time. But I just encourage everybody to remain dispassionate when it comes to your investment portfolio. So it begs the question, what should you possibly be doing, if anything? And I think the best thing to do is to go back with your financial advisor and reconfirm your long-term strategic goals. Get out that old risk questionnaire that you took when you originally sat down. Say, well, what is this money for? It's for my retirement. Okay, I'm gonna use myself. I'm 53. I want to retire at 65. How important is the price of the stock market today? Well, let's take a look at something. I'm going to bring my little chart back into the system here. We're going to have a little fun. If I bring in this and I say, let's look at the S&P 500 index, and wow, it's up beautifully today, up 70 points, 71 points. You can see that there. I want to remind myself that I didn't invest one time in my life. I started investing when I got out of college and started working. And I came out of my paycheck in my 401k, and I started with a zero balance, but I've been investing since 1988. Okay, great. And I didn't sell all my investments on this day, March 23rd. No way. Matter of fact, I didn't sell any, and I hope none of you did either. So if I didn't buy on this day and I didn't sell on this day, why are people telling each other they've lost 34%? And by the way, nobody should have 100% of their portfolio in stocks. Depending on your age and tolerance for volatility and risk, maybe you have 60%, and the other 40% are in bonds, which might actually be up this year. And let's take it a step further for those of you that, well, I'm already retired. I'm on a fixed income. I get Social Security and I live off of my portfolio. Well, interest rates are so low, your portfolio, you can't live off CDs like you could in the 80s if you retired in the early 80s, or bonds like you could back then. So today, if you have a balanced blended portfolio and it kicks off 2.5% in interest and dividends, and the financial advisor tells you should really be living on 4% is the golden rule, take 4% of your portfolio out. So what it really means is with 2.5% income and a 4% distribution, you're really selling 1.5% of your portfolio per year. Divided by 12 months is a little bit more than 0.1% per month of your principal being sold in order to fund that 4% distribution. So again, if you were unlucky enough to catch March 23rd, it was one monthly distribution in 1 year during a retirement that we hope lasts for multiple decades. You need to really put that in perspective. If you're panicking, it's normal to panic. It's biological to panic. It's the fight or flight. But reconfirm those long-term strategic goals and your risk tolerance and your time horizon. And stay away from nervous energy. If you're one of those ones that's impacted by the news, stop watching it and just read your news and read your data and come to your own conclusions about what's happening in the world. Recognize that drops in stock prices are normal. This one is very large, was very large. It was very sudden. It was out of the blue, but everyone has its unique characteristics. This one is no different. And when your portfolio goes down, I'm just going to make a simple analogy. If you're a 50% stock and 50% bond investor and stocks go down, you're now 40-60, let's say. It's simple. rebalance. Sell some of the thing that's up, buy some of the thing that's down, buy low, sell high, brings it back into balance. And when the market turns, you'll probably be better off than you would have been in a straight line up bear market. Of course, all investment plans should include you having 6 months of liquidity on the side in case something does happen where the markets are shut down or illiquid for a period of time. It's always a possibility. Remote though, but a possibility. So what are we doing in your portfolio? Well, we're doing a lot of things. We're of the tactical view that bonds are overvalued, so we are overweight stocks. We hope that as fear fades away, stock market will continue to recover as it has been. We believe that market dislocations like this are very temporary. We believe they will always be reversed, and we're not smart enough to pick the exact bottom. It looks like it was March 23rd, but I can't really say for sure. So what we do is whenever we see a big decline in the market, we take that opportunity to rebalance your portfolios. Currently, I have in my mind a target. Perhaps if we reach 2250 on the S&P, we'll probably do it again. If we don't reach it, the market keeps going up, that's okay too, because we did it on March 23rd and we did it again on April 20th. The other thing I like to do is look for those sectors, countries, or industries that are incredibly oversold. And we identified the hardest hit industry out there. It's the airline industry, maybe along with the hotel industry. There's an ETF called JETS, J-E-T-S, that invests in airlines. I don't want to take the risk of a single airline, so I bought the broad basket, and I'm willing to wait. I bought it on March 6th. We rebalanced it to target on the 23rd of March and again on the 20th of April. And this happened to us back in the financial crisis of 2008. I'll show you a little fun right here. Take a look at the home builders ETF, and I'll graph that sucker for you. And we're going to go back here to 2007 to 2012, just picking some dates here. You can see this looks a lot like the airline stocks of today, this big downward move. Well, we started buying in late 08 and early 09, and we had to be very patient. But this is where it gets interesting, and this is how you make money. It's all about percentages, right? So if I take this and say, well, what was the decline? Well, that percentage decline was 82%. We've seen about that in the airline industry. But if you go from the bottom just back here, which is nowhere near back to even, you can see that's 134%. So if we have to accumulate over 3, 4, 5, 6 months these airlines, we're more than willing to do that because we believe in the end, when the economy recovers, it will pay off and work to our advantage. So I went about 45 minutes like we're supposed to, and I see we still have a lot of people, everybody's still online. I thank you for that opportunity. I will turn the call back over now to Jeff or whoever is taking over for me.
Thank you very much, Herb. Just as a reminder, if anybody has any questions, you can type them into the question box on the panel. It's on my right-hand side of the screen. There is a question I have for you, Herb. It appears that we are spending a lot more than we actually have, and our deficit was already increasing extremely quickly. How do you think this will affect 2021?
Well, I think the answer to that is yes. What you see is accurate. We perpetually run budget deficits in the United States. There's a very small political group that sort of advocates these balanced budgets, but they're not in any way, shape, or form in any center of influence today. So the U.S. is in a unique situation, unique position in the world. Having your currency as the world's reserve currency enables you to play this game. It's a dangerous game. I'm not saying I think it's smart at all times, but that is that you can run a perpetual budget deficit. If you have a trade deficit with a country like we do with, say, China has all your money because you bought stuff from them. What do they do with that money? They buy your treasuries and they hold your treasuries. The treasuries finance your budget deficit. And because there's no other currency in the world that is able to be competitive with the US dollar in terms of safety around rule of law, around contract dispute, around an independent central bank, there is no alternative. So the U.S. is uniquely able to do this where some poorer countries literally are not. That being said, the risk is real, it's substantial. It won't come home to roost in 2021. It will come home to roost at a future date, when interest rates are higher. I mentioned earlier we were very lucky that it happened when our economy was so strong. We're even luckier that it happened when interest rates were so low. Any others,
Thank
Jeff?
you for that. I have another question. We have a couple that are first-time home buyers on the call, and they're interested in knowing what your thoughts are about home prices.
Well, look, the real assets like home, and I'm going to, for the purposes of this discussion, call stocks a real asset. They're incredible inflation hedges, and they tend to have a long-term upward move. And more importantly, they kind of lock in, for the most part, your housing costs, particularly if you're new and young. You lock in that cost. It's usually a stretch when you get in, but then 3, 5, 10, 20 years. I've been in my house for 18 years, and my wife and I are starting to feel pretty good about it, right? So our mortgage payment's not going up because it was a payment we got 18 years ago. And that's why home ownership, of course, is so great. You lock that in, maybe you get it paid off by the time you retire, et cetera. In the short term, there's going to be some impact on the housing market. People aren't out looking to buying. Home builder sentiment is down. Prices may fluctuate. But if you had a decent amount of equity when you got in and you are paying your mortgage, I think it's a phenomenal investment. I only wish that I had been able to keep every home I ever purchased prior to my current one. If I was in a position when I moved up, as a young couple, when Mary and I moved up, if we had done that, of course, we'd have a beautiful portfolio of rental properties today. So short term, there's probably some impact, maybe a little softening, because I know the banks are tightening. Some of the banks, I don't know about CalCoast, but some are tightening their lending standards during this period because they're worried about people being able to make payments. They should be, right? Back to you, Jeff.
All right, one final question. I'm sorry we can't get to every question on the screen. I will attempt to answer those in the question box, or I would encourage you to reach out to your financial advisor at CalCoast. But the last question is, since there's not much room for the Fed to further drop rates if the economy continues to worsen, what other tools are available to them?
Wow, that could be a 2-hour discussion. And the Fed does very routinely say we have many more tools in the toolbox. And rather than get into all of them, I'll probably get some of them wrong. I always end up being surprised, even after 30 some odd years, when the Fed enacts this rule or this contingency plan, or goes to Congress for permission to do something else, which happened recently, and Mnuchin gave them that permission under his authority as the Secretary of the Treasury. But I think also it's the fiscal side right now. The Fed is, I don't know that the Fed is the solution right now, because they've done all the liquidity measures. They've fixed the credit markets. They've lowered interest rates. And so there's tools. They're not the sharpest of tools, but they have more. Really, it comes to the fiscal side. And what is nice is these fiscal responses seem to be bipartisan for the time being, although I think as we now move towards the debate on reopening state by state, I'm seeing the political divisions come back to the forefront of the discussion. One final reminder, if you're on the Twitter, give me a follow at ETF_strategist. I want to thank CalCoast. I want to thank Jeff Anderson from Efficient Market Advisors for putting this on. Sandra Torres, Josh Antis, really appreciate you guys allowing me to be here. And we'll hopefully do it again soon.